Very good morning to one and all. My name is Aditi Bari, a student of Deep Education Society, SAS Institute of Management and Studies. Today I am going to present a PPT on financial market and institution. My topic name is stock market. What is a stock market? A stock market or equity market is a market for the trading of company stock and derivatives at an aggregate price. The size of the world stock market was estimated at about 36.6 trillion USD at the beginning of October 2008. What is a share stock equity? Shares represent a fraction of ownership in a business. The common features of all this is equity participation. Different class of shares have different voting rights. Ownership of share is documented by a legal document that specifies the amount of shares owned by the shareholder and other specific of the shares such as the per value of or the class of the shares. These days, these stock certificates have been determined who is a shareholder. A shareholder is an individual or company that illegally owns one or more share of a company. Shareholders are granted privilege depending on the class of stock, including the right to vote on matters such as elections to the board of directors, the right to share in distributions of the company's income, the right to purchase new shares issued by the company, and the right to company assets during a liquidations of the company. Shareholders vary from individual stock investors to large hedge fund trades. Why does a company issue shares to the public? A company may want additional capital to invest in new product. The promoters may simply wish to reduce their holding, freeing up capital for their own private use. Once a company is listed, it will be able to issue further share via a right issue, thereby again providing himself with capital or expansion without incurring any debt. Financing a company through the sale of stock in a company is known as equity financing. Trading. The share of a company are in general be transferable from one shareholder to another. This leads to buying and selling the share, termed as trading. Investors usually buy and sell share on the exchange through a stockbroker registered with the exchange. A company may list its shares on a exchange by maintaining the listing requirements of a particular stock exchange. Share price determination. At any given moment, the price is strictly a result of supply and demand. The supply is the number of shares offered for sale at any one moment. The demand is the number of shares investors which wish to buy at exactly that same time. Actual trades are based on an acquisition market model there where a potential buyer bids a specific price for a stock and potential seller asks a specific price for the stock. Listing requirements. The set of conditions imposed by a given stock exchange upon companies that want to be listed on the exchange. Example includes minimum number of shares outstanding, minimum market capitalization, and minimum annual income. These requirements vary from exchange to exchange. Example, Bombay Stock Exchange BSE has requirements for a minimum market capitalization. Ways of buying and selling share. Through a stockbroker, they arrange the transfer of stock from seller to buyer. Both the buyer and the seller of the share pay commission known as brokerage to the broker. Leverage strategies. Margin buying stock on margin means buying stock with money borrowed against the stock in the same account. Stock market index. The movement of the price in the market or selection of market are captured in price in it's called stock market. Stock market crashes. A stock market crash is often defined as a sharp dip in share price of equities listed on the stock. Thank you.